In this chapter, we're going to talk about the money markets, an incredibly important topic because, if anything, the money market deals with the liquidity issue that's in every market. Okay, so um, as I said, the money market is dealing with the problem of liquidity, and it's where we're seeing short-term debt existing. And the role that the short-term debt plays is that it does provide some semblance of liquidity while also providing some semblance of return. Because here's the problem, right? Cash has instant liquidity, but it provides no rate of return. In fact, it's got a negative rate of return, if only because of inflation. On the other hand, you could have debt that comes due 60 days from now and would have to pay some non-zero amount of interest. But most individuals don't need instant liquidity. They can survive on liquidity that's available only after 60 days. So for that reason, the money market plays that central role there of providing both short-term debt needs, borrowing needs for companies, but also provide, and you would need that because, let's say, of your invoices, or you would need that, for instance, because of the time it takes for a certain financial transaction like a merger to occur. So a business would have a need for short-term borrowing, but also the savers, on the other hand, could also have some need for short-term investments. For the most part, a great deal of this market exists in the wholesale market. That would be basically large volume, where you would basically, banks would collect all of their 60-day loans into a single package and then market that to investors. Obviously, as I'm saying here, short-term debt, the 60-day, usually I'm saying 60 days because that's a typical time frame. Again, that's just, you're getting interest and repayment usually within 30 days, 60 days, maybe even 90 days. They obviously have a high level of liquidity. And for the most part, most businesses, even if they're incredibly weak, will not fail in that short span of time. I've already just said this. I already gave away the punchline for this. But there's obviously a need for a money market. What the money market does here is it allows a place for some return to be made for the saver that has excess cash and doesn't need immediate liquidity. For the institutional investor, it also allows some place to place cash to earn a rate of return for the investors in that institutional fund and allow some rate of return to be earned. I didn't mention this, but it also allows banks to get that 60-day invoice financing that they provided to a business. It allows them to get that off of their books and continue making loans. So it allows them to get that off their books. But then also too, it allows the individuals that are saving to be able to get a higher rate of return and keep those funds within the banking system. Some of this I already gave away as well, but we obviously see with large corporations, again, this would be the need for a 60-day loan, for instance, to fund an equipment purchase or an invoice that hasn't been paid yet. You could also see it with a government. The government would need this for certain debt loans that are made for those to be refinanced. It takes time for things to work through the market. And we'd also see it with commercial banks that are issuing these bonds, and they need to finance other debts that are coming due right away. Now, the most common short-term debt out there are the treasury bills. I know that we have sorry, I'm just going to look on my computer at the same time. We have a 4-week, 8-week, 13-week, 26-week, 52-week. So those are the common ones. You do have some that are just a few days, but T-bills seem to be the 4-week, 8-week, 13-week, 26-week, 52-week. So generally speaking, the higher the time period, the higher the interest rate. Now, these short-term debts are incredibly safe. And again, the government would use this money to finance things just because the tax revenue flows, which are the most important source of revenue for the federal government, those tax revenue flows also ebb and flow over the year. Obviously, a big chunk of it comes in on April 15th. Big corporations and high wealth individuals make their tax payments on a quarterly basis. But you can imagine in the middle of a quarter or sometime other than April, they don't have the money. Treasury bills would serve that role of financing the government at a time when tax revenue is not coming in. Some of this I already just said, but those are also, you can do this by days as well. 1 month, 3 months, 6 months. These bills, these treasury bills, you can buy them yourself. There was a time in my life when I used to do this a lot. You make quite a bit of money from it. I did it when I was single and I had time on my hands to make money. These days, dude, I don't have any time to make money for cool things like this. Let's just show you here if you're interested in doing this. You would go to treasurydirect.gov. You'll have to create an account. We're not doing this for savings bonds. But you would go to the marketable treasury securities. Let's look at the recent auctions. So you would see here are the various treasury bills, 4-week, 8-week, 13-week, 26-week, and these are that was this week's auctions, last week's auctions, and so on and so forth. And basically, you're making money. The way you would make money on this is buy it at higher interest rate times and then sell those bonds back, those bills back before they become due, and make money on the differential. Even though it might not seem like a very big difference, there's quite a bit of money you can make on this, depending on the volatility of the interest rates. Here, we can see that on 3/2, 4-week bond bill was for 0.035% interest. Today, that same bill is 0.030, meaning there's a difference of 0.005, which again may not seem like a lot, but you made that money not doing anything, just holding it for a little while. So then if you were going to do this to make money here, you would go into upcoming auctions and you would then start to plan. You would see here that the government's going to issue $57 billion of 13-week bonds on the 15th. So this coming Monday, those bonds would then be issued on the 18th. Same with the 26-week. And then you can kind of plan how you're going to do it. Okay, let's go back to this. I feel like I could teach a whole class on just treasury bond investing. It is true. You do need to put in about $1,000 at least. Dude, don't do it this way. You can, but you'd pay so much in commissions, you wouldn't make any money. Really, the only way to do it is this. If you're not comfortable doing that, then you shouldn't be in this. But I shouldn't have erased it because it is, you can buy it indirectly through mutual funds and whatnot, but you won't make any money doing it. You'll just be participating in the market. Okay. Generally speaking, the way that these are priced is that the interest rate is internal to the issue price, meaning that you basically get the face value back at the redemption date, but you pay less at the issue date. So that difference is the interest that would have been earned. You basically, when you engage at treasurydirect.gov, you make a bid, and basically the government knows how much money it needs for a certain auction time, and it basically goes, it's going to go from, for the bids, it's going to go from highest price to lowest price. Again, when we say highest price, you're saying that the highest price would be 100 cents on the dollar. The lowest price would be 0 cents on the dollar. Because then the difference would be that at redemption, so this would be an issue, if you pay 100 cents on the dollar, when it's redeemed, you'll have made nothing. Because at redemption, regardless, both ways, you're getting 100 cents on the dollar. So inevitably, you are going to lose your first few auctions if you do this. That is the way it'll be. No one bidder can purchase more than 35%. But if you've got 35% to $53 billion, one, you shouldn't be in college. Two, you shouldn't be taking this class. Three, you don't even need to be in college. You should just be earning banco money. So just keep that in mind. I don't think any of you are that secretly rich. Otherwise, you would have paid me for a good grade. To which my official response would have to be, dude, I don't give away free grades. They cost money. They cost $53 billion. $53 billion. Jeez. I'd at least make an extra credit opportunity for you, $53 billion. So obviously, if I'm getting pretty darn close to that 100-cent rate, let's say like 98 cents, then that basically reduces the cost of the government of financing this debt, to the extent that there are others that are lower than that. So they start with the highest bid and go down. It's also the case too that instead of treasurydirect.gov for the financing of things, banks, if they need short-term money, they can also go and use the federal funds market. The federal funds market would be where banks lend their reserves to each other. That federal funds rate is targeted by the Federal Reserve. So we can basically, in the short-term money markets, we have the treasurydirect.gov, the T-bills market, but then we also have the federal funds market, banks lending their reserves to each other. With that interest, so the interest rate for this market is obviously determined by an auction. The interest rate for this, the federal funds rate, is targeted by the Federal Reserve. Then we've got the commercial paper market. Now here is where you can really make the money. I've dabbled in this as well. You really would need to go through a broker to do this commercial paper market. So now you'd want to just find your lowest cost. E-Trade's a good place to go to for this. Schwab's got some inventory, but it's actually not as good as eBay, E-Trade. Unfortunately, or fortunately, your power and prestige is determined by how much you're willing to give and who you know. So if you don't have a lot of money, and you're a nobody and no one knows you and you don't know anyone, it can be very hard for you to buy a lot of commercial paper to make money. Now, you build up a reputation over time, you get to know people in the industry, you can start to get some influence. So it was only towards the end where I actually started making money on this. And then I moved from the mainland to Hawaii, and Hawaii's, you start to lose your contacts, et cetera, and it just becomes more difficult to rebuild that. But again, basically, commercial paper would be anything generally less than 9 months, and you basically have companies that are either funding large invoices, funding their payroll, et cetera, et cetera. Here, you have to worry a little bit more about the company and its ability to survive that 9 months, because this is unsecured debt. Though it is possible that you would be that the company could go bankrupt in that 9 months if things did change significantly enough. Then we've got the repo market, the repurchase agreement market. This is the repo market is generally overnight loans, loans for an incredibly short period of time. And the participants in this money market, type of money market, the repo market, are the security agencies. This is what brought down Lehman Brothers. Lehman Brothers, when it failed in 2000, during the 2008-2009 crisis, it was unable to access the repo market. This market is incredibly opaque, meaning it's not transparent at all, and it really relies on trust. Lehman Brothers failed, even though I would argue it shouldn't have, because it did have assets. It's just that those assets started to become underpriced. And then the moment that the competitors, the Lehman Brothers, realized that their competitor was weak, they stopped financing it in the repo market. And what the repo market does is it provides the financing needed when securities are traded, because there's a difference between the trade date and the settlement date. And it's a few days. And so in those few days, the that bank or that investment bank, in this case Lehman Brothers, is holding that responsibility on its book for a few days. To finance that, it needs to participate in the repo market. If it loses that, it loses its ability to trade and thus ceases to exist. You do have negotiable certificates of deposit, but you don't really, I mean, you don't see these that often. My wife sometimes will get a client that has one of these if a house was sold or something like that, but these aren't that common. Even in Hawaii, where savers love CDs, you just don't see these that often. Most sophisticated short-term market savers, there's just, you're not making any money on this. You're really not. You have to be a quite unsophisticated investor to just buy a negotiable certificate of deposit, because now you're going through two middlemen who are both taking their cuts. You're going to have to go through the bank, which is one of the middlemen's, and the money market, where the bank is going to get where it's going to put the money into. So your profit margin's getting cut twice. The only way you can really make money in the money market, in the short-term market, is by reducing the number of middlemen. Right? So that's why in government securities, you can make a lot of money because you're dealing directly with the government. You could even make money in the commercial paper market because E-Trade as a middleman, or E-Trade again as a middleman, isn't charging that big of commissions. Even Schwab's not charging that big of commissions for you to participate in those markets. You have banker letters, banker acceptance, these letters of credit. You use these for international trade invoices where you have to engage in the foreign exchange market before you can even pay out the invoice. None of us in this class, unless you're that $53 billion person, none of us in this class will probably ever participate in this market. You'd have to have a lot of money. We're talking millions of dollars. Because what you're basically doing is there's a period of time where the container is on the ship going across the ocean, where neither the manufacturer owns it nor the receiver owns it yet. Technically speaking, the shipping company owns it, or the train owns it, or the insurance agency owns it. And so there'd have to be some financing involved in that. And you would do that with a letter of credit. And then finally, you've got the euro dollar accounts. We wouldn't see these. International airlines use these. Governments use these. Large international banks use these, but again, just in very large corporations with large multinational operations, like a Coca-Cola or Procter and Gamble. I knew this one person that worked at Anheuser-Busch, the beer company, and she did facilitated transactions like this, but that's pretty rare. Okay, that's it for this short but important chapter.